What's up, Outliers? Happy Wednesday. Today's agenda, we're going to do a quick stock market recap. And then I want to actually do another recap of the monthly AMA that I do on Reddit. I will continue to remind you guys, I genuinely feel like Reddit is probably one of the best possible places to get the actual pulse of a beginner level options trader. Now, there's other entities on there, I'm sure, but the absolute bulk of people that you're going to find on Reddit in the options sub are going to be beginners. So we can learn a lot about the way that they think about things. And we can also use it as a benchmark to see how far we've progressed, because sometimes in trading it's really difficult to see how far you've progressed in a lot of ways. And a big part of that is because the ultimate long-term expression of your progression is your P&L. But notice how I mentioned the ultimate long-term expression. That's because in shorter term timeframes, you might not actually see that just yet. You might be doing the right things and actually experiencing a negative P&L. That's all part of the game. It's actually one of the most difficult aspects of trading, is that you genuinely can do all of the right things and still find yourself not seeing the result that you might want to see. But that's generally due to shorter term path versus longer term expectancy. What's up, Lauren and ZX? Lauren says your podcast today was good. That's awesome. Yeah. The podcast she's referring to is, I just launched a podcast episode with Andrew Mack. He's a friend and he's a cool guy. He is also somebody that I connect with from the retail trading space a little bit more deeply. And that's because, like me, he's been retail the entire time. He's never been on the institutional side, which for a lot of the people that I have conversations with and I work with on a daily basis, that is actually quite anomalous. Most people that are at a deeper professional level in the options trading world come from professional backgrounds in some capacity that then either choose to leave and start their own business. I actually don't find too many that trade their own book. Most of them just stay at the institutional side when they're operating there, kind of at that level. But every once in a while, I'll come across people that actually are much closer to what I am and what I do, not in terms of methodology or approach, but in terms of background. Because again, I don't even have any sort of professional finance background, let alone anything specific to trading. My background obviously is more on the statistics side of stuff, but quite a bit different. So let's talk really quick. I don't want to go through all the sectors and stuff. We actually just did that yesterday, so I'm going to skip that for this stream. And we'll talk a little bit more about the Fed, because we just had the rate statement come out as overwhelmingly expected. No change. And there's also now talk about inflation fears kind of spiking up a little bit. Again, these are the interesting things I find about markets, because there is absolutely no part of me that thinks that the market wouldn't expect that war is inflationary. We know this. We know this beyond the shadow of a doubt. So when Powell essentially says that, the market starts unwinding, again, not insane, but the market had a pretty decent move into the end of the day today. It was down 1.36%. That's a moderate day. And most of that obviously progressed to the downside. I just find those relationships fascinating, because obviously they're reacting to what Powell said and now reading into this hawkish sentiment, supposedly, and concerned about future rate cuts, and inflation is starting to become a bigger topic again. But I don't think any of this was necessarily not expected. The market reaction, I think, as usual, is a little aggressive. I think a lot of that has to do with actually shorter term systems that are designed to play on this. But I find it takes a little while to actually get to the fair pricing of things. And you kind of have to get through the really short term noise, because I think that's a lot of what ended up happening today was kind of shorter term noise. Again, we'll see. I don't know any better than anybody else. But the other thing that I did note is that net highs lows flipped, and it actually flipped quite aggressively. So specifically, NASDAQ floated down again pretty heavily, and its 20 period moving average has been negative sloping pretty much going back to January 30th. It's been negative sloping breadth. It did have a small uptick back in the beginning of March. That's just continued to be generally unrelenting downward slope. We've already talked about these yesterday, and writ large, breadth doesn't look good. Like that's just full stop the reality. It doesn't look abysmal. I don't see anything in here that I feel like the sky is crashing, but that also does not change the broader context that it does not look good. You have vol clustering in the mid 20 handle, which is objectively high. You have the indices all performing like pretty poorly. S&P and Qs kind of same on the day, but slightly worse 1 week performance than something like SPY. Small caps is still kind of doing its own thing, but still a little more volatility to the downside than the others. And then other breadth indicators, like the percentage of S&P 500 companies above their 50 period moving average. That's even lower now. That's now at 29%. That's actually low. That becomes quite anomalous down here. You can see we're already past a 2 standard deviation on a 6-month time frame. But again, as always, the thing to remember with stuff like this is also nuanced. And a lot of that is because the markets have been oscillating sideways for so freaking long now that all of the moving averages have constrained massively. So the way I was talking about this yesterday, the way that I interpret the move here is not the same. And when I say the move, I mean like the move in a breadth indicator, like the percentage of companies above a 50 period moving average. The way that I perceive this isn't the same as if we're going through some sort of massive aggressive upside market. Now, that being said, I will say that the down move here, especially if we go back to the 3rd of March, this is the main thing to pay attention to, is if we look at S&P 500, it started its downward descent like the beginning of February. But at that time, the percentage of companies above their 50 period moving average was still quite healthy. It's a lagging indicator. So we start to see this decline. It's going to take a while for this to catch up. And for actually a little while, most of the decline was pretty siloed. It wasn't spread across all of the sectors like it is now. But then as things have progressed, that downward bias has absolutely extended into multiple sectors now. So for example, previously healthcare was actually kind of a bastion of strength. It's been doing quite well leading up until the beginning of March. And then from there, it's now started its unwind. So what's happening here is in the beginning of this initial downturn, it was actually quite siloed. And that has changed. It's now expanded. The one thing that's remained the same across the board is energy is still leading and utilities is still close thereafter. Except a big difference is these are your only 2 leaders. So out of the 11 primary sectors, you got 2 that are actually performing well and generally leading to the upside. Everything else at best is riding sideways. And in general, a lot of these are doing worse than that, especially over the last month or so. We'll see how it progresses. As always, Nobody knows. I don't attempt to predict that stuff. I actually spend most of my time just positioning. And right now, I still have my core long position on. I've talked about that stuff quite extensively. I'm still trading the coverage triangle to the upside, except as I've talked about the current utilization is light, really light. So in something like TQQs, as I've talked about before, my total utilization in TQQs is super light. And it's because of this. It's just because things don't look that great. The things that I'm playing to the upside are things that have clearly demonstrated strength. And there's a few examples of that more recently that we can look through. And then also playing direct weakness. That's another specific angle that I'm targeting. So I'm still long in stuff like Occidental. And this is right now still just long calls. I would consider this a ratio call diagonal-esque campaign. I just haven't offered the shorts just yet. Another example is SEI. So I actually entered SEI here on this breakout. I actually have absolutely no idea anything about this company whatsoever. No clue. I don't know what they do. It looks like they have a sun in their picture. That looks cool. So I'm guessing some shit with the sun. It says energy infrastructure. So that makes sense why that might be participating. Clearly some sort of news came out, a catalyst here. Again, no idea what the fuck it was. Still don't know. But this is just another example of trading momentum. Like that's all this is. So the main point that I want to make sure that we're all acknowledging is that even though the markets look the way they do, and even though that there's definitely no shortage of weakness, there's still strength. There's always strength. There will always be strength, even when markets look ugly. The key is that you just have to be way more selective, because during bull markets, lots of stuff looks strong. And that's, again, due to some actually well-studied effect, not, what you'll commonly hear cited stuff like animal spirits. But that's not part of it, by the way. But that is, a common term that you'll hear during those periods. But it also has to do with just overall business growth, valuations, and synergistic effects. Businesses are intimately tied to one another. As general business is doing well, things are growing and expansionary, it tends to flow into other names. But there's a lot of stuff right now that looks really good to me. So both to the upside and to the downside. And what was it? Sunday, we talked about a handful of stuff to the downside that looks pretty bad. So one example of there is American Airlines. In this, I'm still short calls. It, as you might guess, gapped up originally because, the market knew that I was getting short. So why not make it painful? Market has a great sense of humor. Ha ha, market. Ha ha. But it's still well within range. I don't see stuff like this immediately doing well. That's why it's short calls. I'm not really trading stuff like this hyper aggressively to the downside, not doing that. But until we get some sort of clear break in the conflict and this expectation of freedom of movement of things like crude, easy plays. Like, they're really just easy plays. They're easy in the sense that there's not a whole lot to them, but they intuitively align with the broader market paradigm right now. To summarize all of that, lots of places to find strength. There's no reason why you can't find names that are doing well if you prefer to trade to the long side. If you prefer trading long short, then you should be stoked right now because there's a million things to do. And if you trade exclusively to the short side, which I have to be honest, I don't know a single retail trader that does that. That doesn't mean that they don't exist. I don't want that to be interpreted that way. I just don't know any personally that only trade to the short side. Almost every that I know, even if some of them have a dominant short side preference, they still trade stuff to the long side, and intuitively so. Market spends most of its fucking time going up. Kind of makes sense. All right, let me get caught up with you guys. Lauren says Powell was his chipper self today. Yeah, Powell always. I've said this before, though. One thing I really do respect about Powell is that he's fucking consistent. When it comes to people like him in roles like his, I think it's a stabilizing force. Because realistically, again, regardless of what you think of Trump and politics in general, I think objectively, everybody would align that Trump is hyperbolic, right? He speaks in extremes. Things are the best, things are the worst, things are the greatest, things were, stuff like that. Which again, there's pros and cons to that style, highly charismatic. I'm not talking shit here, supporting or defending or either or, but there's a drawback to that. And when you speak in hyperbole, that just is naturally charging, good or bad. Powell is a stark contrast to that. It's not hyperbole, and it's just kind of factual from his lens, at least, and neutral, just regular speech pattern, nothing exciting, nothing really that charismatic about it. But I think that in general, he's done a good job with his messaging and his way to message. He's been very consistent, which I actually can appreciate that. That said, there's a lot of interplay between Fed, Trump, specifically Powell, Trump, and all that shit. That's a whole other fucking can of worms that I actually have less than zero interest in. But it is a thing, at least to acknowledge exists and to be aware of for sure. Hey, what's up, Tom and Kirk? Steve says, forgot who said this, but it was other countries aren't selling America, but they were avoiding America. Not sure how much that hurts volume trading wise. I don't even really know what that means. It's like, I do know what that means. People can try to do business elsewhere, but it doesn't really matter because America is still a big part of pretty much most other main developed countries' economies in terms of what kind of trade they do. So again, like people might be talking about it. They might be seeking to avoid America in, some fashion compared to a prior state, but it's not binary. And most countries that somebody would be talking about in that capacity are still going to be doing business with America in some capacity. That really hasn't changed. So yeah, that to me honestly just sounds kind of like a regular pundit talking point. Now, if there's good data to talk about there, I'm always receptive to that. And there is good data that quite a few countries have absolutely slowed down their trade with the US, but there's still a lot of trade with individual companies in the US. So a lot of that is, again, we could intuitively surmise is that the whole tariff thing, that's a tough way to do business with a country that pretty much every other day we decide different amounts of tariffs on different amounts and different places and different commodities. And then we go back on it and then we put them back on. That, like, nobody wants that instability. That's tough to be a trade partner with. So a lot of people would probably definitely look to shrink their footprint if they can. I think that's fair. Tom says, surprising that flight to safety staples has also fallen off. Yeah, I've actually been doing a bit of research on that. So let's actually talk about that for a second, because it's a good point and it's actually really good that you identify that. That's like the exact kind of stuff that you definitely want to be picking up on. But the curious thing is Staples doesn't necessarily behave the way people think it does in terms of like how defensive it is, how risk on, risk off it is. And I think it's for a few main reasons. Let's just flip through Staples really quick. We'll just do it alphabetically first and see what generally sticks out to us. The first thing is some of the companies in here that tend to do well continue to do well. So Costco is a great example. DG, another great example. Dollar Tree, another great example. Hershey's, a good example. Coca-Cola tends to do well. Kroger tends to do well. So a lot of the things in here that tend to do well are actually continuing to do quite well. Even things like Mosaic is still doing absolutely fine. Target is fine. Walmart is fine. All of these are generally doing okay. However, there's a pretty profound bucket that have just been doing really, really poor. And we're talking like down 25% plus over the last year. If we look through where these are, we can see a lot of it is in food. Food, miscellaneous, diversified, which is the general industry. It's kind of like a broad parent umbrella. What this tells us actually quite clearly is that at the industry level, there's still a rotation going on. And there's a clear preference for the standard defensive names that you'll find in retail. Tobacco is typically there. Supermarkets, typically there. Agricultural, can take it or leave it. That kind of flips around. I would consider that a little more cyclical. But the stuff that tends to do well in defensive periods is actually still doing pretty well in defensive periods. It's just the rest of the broad sector, as we break it apart into industries, there's a clear industry trend. And let's think about what's going on in the food industry. Well, Kennedy Jr., he's been all over it. And they're actually attacking a ton of direct inputs to their model. They're going as far as trying to do things like, banning food dyes, which, as small as that sounds, these companies use food dyes for a reason. And it's because they've quite literally figured out how to engineer food and snacks and whatnot to be so appealing. And part of that is the visual appearance and color. So that there's a ton that goes into that that's now being toyed with, which, again, for my completely unsolicited opinion, I would be stoked if fucking food dyes were completely not allowed in food, period. I've always found that confounding, other than the fact that it's just marketing. Like that's really what it is. There's a clear trend going on in most of the underperforming segments of the industry within what people would typically consider to be, defensive. So the point that I'm making, and this is why having a general touch and understanding of markets is so useful, because at a high level, it does look kind of weird that what would consider to be more defensive style spending or defensive style holdings is not doing well. But then if we double click into it, we kind of realize a lot of it's actually still doing pretty well. But there are really nuanced things going on with some of the general industries that are in. Dookie says small and mid caps in this environment are about to run. I mean, that's a hot take. That's definitely a hot take. I would get behind that take if the current environment abates. But there's actually really very little advantageous about the current environment, specifically for small caps. Mid caps, I don't really have a super strong opinion on. That's going to be way more sector and industry driven than them being a mid cap stock. But small caps, this actually is not good. The reason for that is as soon as we start looking at, again, slowing rate cuts, which have been massively priced in to small caps, and if that probability of, it used to be, a pretty good probability of 2 cuts into the end of the year, and even that's starting to come into question. And then we start talking a little bit about inflation and how at least near-term inflation is becoming a concern again. All of those are actually really not good for small caps. So yeah, I definitely would say that's a hot take that I do not agree with. The element of it that I would agree with, and I've said this previously, is I do think small caps still have more ground to make up compared to the large caps and mid caps. That I think provides a bit of a coiled spring for them. So the way I look at that is like when the environment does change and becomes more favorable to them, then I definitely think that they can run. And I said that before. I've said that on multiple live streams previously. People have known I was trading the original series of moves that happened as soon as the rate environment changed, this back here. And that's because this was a massively, massively overdone move. Again, overdone is subjective. I simply mean in terms of depth. Like this was an aggressive move compared to the rest. And then as soon as we start getting into the cutting campaign, I mean, that led to one of the most prolific moves that we've seen in small caps. This amounted to almost 45% in like half a year. An insane move that it took off with. This environment, I think, is, and again, like it's not even like what I'm saying, that the market is also telling us it's almost in a correction at this point. It's down 8.5% from term highs. But I do think that when the environment does change, the way that that looks is war in Iran is resolved to some degree, stabilizing oil prices, stabilizing these discussions and concerns around inflation, stabilizing the rate cut series and projections. Then I think small caps can crush it. I still think that they have more ground to make up than the others. So yeah, from that lens, I think so. But near term, this is actually a really tough environment for small caps from a just general structural lens. Tom says, where would you look up to assess the strength of the consumer? I'm hesitant to say because I think like this idea of strength of the consumer is, I don't know. I feel some type of way about it. But anyways, that part aside, the places to look it up is in Fred, for sure. In earnings statements from retailers, big retailers. You can use Fred to figure out all different kinds of metrics. And I think I've shared, like at least one of the Fred dashboards that I use with you guys for context. Let me sign in real quick and I'll show it to you. Stuff like this. So I'll use stuff like debt service as a percentage of disposable income, delinquency rates, but specifically delinquency rates, you have to bifurcate it because a lot of these will be for large loans and stuff. So you kind of have to channel it down into smaller stuff to figure out, charge off rates by credit cards. That's essentially, debt that they know that they're not getting back. Sales of vehicles, used vehicles, homes, all of that stuff, bank balances, credit balances. Those are all like general data points that I would look at. But the easiest to consume for sure would literally just be coming up with a list of curated earnings that you pay attention to and monitor. So that's stuff like Walmart, Dollar Tree, Target, those kind of places, Kroger. You can read their earnings statements and get a pretty good idea of just general health of the consumer. Stuff like this, you're not really going to get a ton of information from it because it lags so much. There's also a bunch of, specific economic reports that we've talked about before and you guys should be generally familiar with. There's things like consumer spending, consumer sentiment, that kind of stuff. Let's take a look over the course of the month and you'll see a few of them. Employment, massive indicator, unemployment, non-farm payrolls, retail sales, like all of these are really some of the primary inputs that you can use that at least give you data on a monthly basis, for sure. So personal income, personal spending, all that stuff. I would just make sure that before going too deep down a macro rabbit hole, that you just have stuff clearly defined, like what you're looking for and what you think there is here, and definitely tying it to a specific profit mechanism. It can get, I think a lot of people can get way too wrapped up in like trying to write a story about what's going on in the market. And there's also a cerebral puzzle solving part of it that's appealing to some people. For other people, it's literally just ego and enjoying sounding smart and shit like that. There's nothing wrong with knowing this stuff. And there's nothing wrong with integrating different kinds of macro and economic data into your understanding of the markets and how you view things. It's really easy to go way off tilt with shit that doesn't matter. So the way that I would summarize that is, does understanding quote unquote health of the consumer, does it hurt you? I mean, technically, actually, it does hurt you if it gets taken to an extreme, but let's pretend that's not the case. Is it likely to hurt you if you have a healthy mindset towards it? No. But you can also easily trade and in like completely successfully with literally looking at none of this shit ever. For sure. You don't need to look at any of this stuff. So I would try to stick to simpler things as much as possible. And then if you find yourself intellectually curious and you think it's interesting, because I do, that's why I track this stuff. And I would say that like there might be a very marginal assist to my overall trading, but it's trivial. It's trivial at best. Most of the time for the pro members, when we're doing our weekly outlook on Sunday, it's more just to understand what volatility is likely to look like during the week ahead, so that we have an idea of if the market is pricing in something because of informed participants versus not. And if you guys remember, on Sunday, we saw that the vol for the week ahead was not that insane, except there was about a 10% bump in today for the Fed rate statement. That at least tells me that the market, and I even said this on the stream, I was surprised that the market was pricing it that heavy because it was generally a pretty sleepy curve, but the market was absolutely pricing today a little bit more than I was expecting. And then obviously we saw a pretty overall, not big move, but decent move on the day. So yeah. Steve says, something I'm trying to figure out is this a pull or correction or heading towards a bear market period? Nobody knows. That like anybody that says they know, they have no fucking clue. The way to think about the problem set though is it's literally impossible to know that. So depending on how you trade, that will determine how you approach things and how you approach that uncertainty. I view it as more of a continuum than anything. There's never a point during this game where I feel like I know what's going to happen. Sometimes I have like a really good hunch, but even then I don't fully know. A good example of that is some of the recent trades that I made in crude when this whole war in Iran popped up. Pretty confident of what I thought I might see, but I still didn't know. But anyways, when it comes to this idea of like a bull market and then a bear market, there's a continuum of shit that happens across this. So the way that I look at it is just, where are we on this continuum and how does that probabilistically leave us in terms of what's likely to happen going forward? So what that looks like is deeply understanding these two markets and their conditions. So the way we do that is by analyzing both of them in depth. We want to know, well, in the beginning, we want to know everything, but then you'll get smarter and you'll start to understand the stuff that matters and doesn't matter. So you can look at things like average daily, weekly, monthly percent move of the indices. You can look at the index relationships. You can look at the volatility complex. You can look at what I do a lot of is breadth indicators, momentum indicators. You don't need a lot of stuff, but what you need to do is understand how some set of defined metrics that are of interest to you and you think are relevant, how those metrics look in this period and then in this period. You will see a difference. So then all you do is monitor these metrics or whatever the metrics are that you find are statistically significant and see where that nets us out on this continuum. It's literally it. But the underlying function is that nobody fucking knows. And that's good. Nobody should know. If they did, that means that we would have all sorts of pricing issues. The other thing to keep in mind is, again, the majority of the time, the market is going to exhibit specific behavior. In one of the skill development live streams, which, by the way, that's actually a good quick caveat. The pro skill development workshop tomorrow is open to everyone. And we're going to be looking at managing risk in a portfolio. I made a post on Discord, and then those that are in the Patreon community, even the free side, you guys will have gotten an email with a link to it. But everybody's welcome to that. In one of those sessions previously, we actually did an entire walkthrough of what bear markets look like and what constitutes bear markets and how do they tend to behave compared against bull markets, and what kind of indicators are useful to us in measuring those kinds of markets. And like I was just explaining, the summation of most of it is that you don't need anything that's too complex, but you need something that's studied really, really well. You understand what it looks like in both of those regimes. A great example is like what I was talking about here in this breadth indicator. This here, and me understanding not only that this is unhealthy in general, but then also being able to contextualize the unhealthy look of it. Again, specifically there is the fact that everything is really compressed because we've been oscillating sideways. That's really useful to me. Also, being able to objectively analyze general trend. And a super simple way to do that is just run different timeframes. So if I look over the last year, I can see standard deviation channels are upward sloping. When the market is expanding, I can see that short-term to long-term moving averages are organized properly, meaning shortest at the top, longest at the bottom, price above them all. I can also see that they're all positive sloping. I can also see that the distance between them is static for some and different for others. These shorter term moving averages, so this is a 10 to a 20, more often than not, that distance is going to be closer than not. It's not going to change a whole lot. However, looking at something like 10 to 200, 20 to 200, or any variation thereof, I generally would expect to see that distance widen. And then when things start to slow down, that distance contracts. This is a general concept of a MACD oscillator, moving average convergence divergence. That's all that is. It's measuring the strength and relationship of two. That's why I don't have MACD, because I look at 5. And the reason why I look at 5 is just because I trade at a bunch of different time frames, and I don't feel like having different charts set up for each time frame that I trade. That would be quite tedious. There are some exceptions to that through stuff like 0 DTEs and pairs trading and futures trading. Those have their own setups, but for like most of the stock stuff, not so much. So yeah, there's a ton of stuff. the thing that I do want to remind people, and this is kind of like the most important part, two things. One, you do not want to over engineer stuff for the downside. This is because the market tends to go up. People lose so much potential capital and return from overemphasizing the scary down move than the overwhelming higher probability event of the market going up. That's the first thing. The second thing is the market doesn't just magically collapse with no warning at all whatsoever. There are always signs. The issue is a lot of times those signs resolve to nothing. They resolve to the market continuing to go up. So if we go back and we kind of cherry pick some periods in here where we might think that the market is starting to slow down or have issues, if we just kind of follow this along like a time series, this looks generally healthy. We're seeing higher highs, higher lows, uptrend, everything looks good. Then we start to see price consolidating back down into this range. Okay, it's still down into this range, and now we get our first shot across the bow. At this point, we've had a high, a similar high here. We have price falling below moving averages first. Then we have moving averages turning negative slope second, shorter term. Then we have moving averages inverting. Then we have price posting a lower low than this consolidation. This is your first shot across the bow. Does this mean that the market is unwinding and going down? Again, nobody fucking knows. But this tells you something, which is if I were to decide to get long, for example, in small caps, it's not right here. I would wait. The other thing that's also going on down here from a breadth indicator perspective is, what do you notice? Net highs lows has literally been negative for 4 fucking days straight, trading days. And on the day of this gap down, it's actually massively aggressively moving to the downside. This is all giving you information that something is unhealthy here. Again, just because that's the case doesn't mean it's going to crash, but what ends up happening doesn't just come out of nowhere with this move. You can literally see something is coming. This ended up not being too much. Sometimes it's more, sometimes it's less. But once you understand how some of these like breadth indicators and momentum indicators work, you're not really like shocked by stuff. It's more just, how do things end up resolving? A good example is if we look at net highs lows here and how negative it was on this kind of day. And then you see this big, massive red day that looks kind of scary. And then if we zoom in on net highs lows on that day, still mixed. It's definitely down for the New York Stock Exchange, but NASDAQ, tech in general, and again, NASDAQ is more than just tech. It's just slightly higher density of tech. They're still positive. They did okay. The slope was downward sloping, but then the second day, they flipped back positive. So you can kind of spot, again, with some level of idea if things are starting to rotate or not. But again, we never fully know. More often than not, it'll look like things are starting to roll down, and then they won't. They'll pop back up. But the way that we understand that is also by doing that homework that I said in the beginning, by deeply understanding bull markets and bear markets. Because one of the things that, again, I'll use for data is our distance off of all-time highs and different durations that we spend at different distances off of all-time highs. This kind of tells me, are we continuing to consolidate off of a high, not making new highs? And that's, again, generally unhealthy for a broader bull market. So there's a ton of stuff that you can look at. The important thing is pick stuff to look at that's logical, that makes sense. And then also you want to make sure that you're picking stuff that you could do a bunch of homework on. You got to see how these things perform historically so that you can prime your brain for what's normal. And then you can more easily detect what's abnormal. But if you don't do that and you kind of just pick random indicators with no context or research with them, they're kind of useless. You're not really going to be able to derive much from them. So the two things, again, that I want to reiterate: market spends most of its time going up. Don't over engineer down. That doesn't mean don't do anything. Should engineer down. Just don't over engineer. The second thing is market drops and contractions don't emerge out of thin fucking air. They always have warning signs. The trick is a lot of times those warning signs resolve to nothing. That psychs a lot of people out. That's one of the benefits of being a small retail trader, though. Because let's say, for example, you're a hedge fund with $10 billion. And let's say that you have a $100 million position in Apple, and you think that the market is starting to roll over. You don't really want to be in your Apple position. It's starting to look like it might be kind of ugly. And you have that massive position. Even though Apple's super liquid, you're still going to get chewed apart in terms of, if I wanted to unwind that entire position, trying to find liquidity, trying not to get just absolutely destroyed on my way out in terms of overall cost. And then there's all of the reporting infrastructure that has to go in. There's a ton of things that have to happen in order for me to unwind that entire position. This is also one of the primary reasons why risk premium is still a thing, because big entities like pension funds, they're not able to unwind their entire fucking equity position every time it looks like the market might be rolling over. But on the retail side, you can be as agile as you want. That is one of the very few edges, and like true edges, that we actually have, is our flexibility. I can be 110% long in my portfolio at the beginning of the day here, and then at the end of the day here, I can be completely flat, or I could be 110% short. I could be whatever. That's really difficult to do in massive portfolios. And what I'm talking about here, I'm not even talking like small retail. It does get, admittedly, a bit more annoying as your account grows. As you start trading several $1 million, you'll notice that some of your positions are kind of annoying to get in and out, especially if you're in certain markets, trading them closer to their capacity. But that's one of the risks you take, and you have to account for that risk in your broad risk management plan, which is, again, something that we'll talk a little bit more about tomorrow. So yeah, ton of stuff that you can look at. There's no reason to be caught completely off guard. Right now, again, I said at the beginning of the stream, and I quite literally have said this straight up for fucking weeks now. Things like, you're getting a warning sign right now. You are getting a very, very clear warning signal. Does that warning signal mean that the market rolls over? Again, nobody fucking knows. But you're getting the warning signal. It's already there. You've gotten it for some time now. The market hasn't made a new high since 27 Jan. It's been pretty much rotating sideways since the 9th of January. That's generally where we started posting near these highs and have been going sideways. So none of this downward move should be taking anybody by surprise, and the potential for a much bigger down move should not take anybody by surprise. You have had, let's see, so far, you've had like 47 trading days to figure it the fuck out. Pretty good heads up, I think. All right. Let me grab a seltzer water really quick. I'll be right back. And then I want to go through the Reddit AMA I did and just some of the conversations I had in there. And then also, if you guys have any specific questions or anything that you want to hit, now's a perfect time to throw those in the chat. Be right back. All right, we're back. I also have acquired a small fuzzy critter that has made his great escape and is now hanging out with me. So we're looking good. Okay. Let me see. Dookie says, tell me what you think of the next decade chart. What the fuck is that? Joe says, if I'm working on developing a trading strategy for myself, learning how to backtest, stress test, what tier in the Patreon would be best? It's kind of like whatever support you need. That's the way that the Patreon is generally built. So the way to think about it is like the pro tier, that's for really anybody. And the main stuff that you'll get as far as resources for that is you'll get access to the community, and there's the free side of the community for everybody anyways. So you'll just get a slightly more involved part of the community. And then you'll get access to like skill development segments and stuff on Thursday. I do those every single Thursday. So we can always slot in stuff about that kind of topic. So that's that. The workshops, so for Pro Plus, that's really where you get a little bit more hands-on with stuff. So the way I would look at it is just how much involvement you want to have on your end and how much involvement you want from my end. That's all it is. So for the standard pro members, it's mostly live streams and then the Discord. Then the Pro Plus members, it's all that stuff. And then they also get a couple Zoom workshops. So that's actually like back and forth style interaction a couple times a month. That's actually scaling up soon in terms of the frequency. I was just talking about that actually yesterday. And then, yeah, I mean, those are kind of like the main spots to go. But before you buy anything realistically, there's a ton of free resources, man. So what I would do is, if your intention is to learn like back testing, stress testing, I would do your absolute best to leverage all the free resources available to you if you want to approach it more like, you know, doing it on your own and learning on your own, understanding the pros and cons of that. But if, let's say, for example, you want to pretty much do it on your own, but you just want a little bit of help understanding order of operations, getting feedback on things, then Pro is completely sufficient for that. But then if you want to spend a little bit more time like actually doing the thing and getting direct feedback on that, then Pro Plus is a pretty good place to go. The coaching side I've already talked about before, but I'm actually scaling that down. I like it a lot, but the thing with coaching that I don't like is just, it's so time intensive. And realistically speaking, I don't feel comfortable pricing it at a level that would make it worth my time. So there's an impasse there, because there's no way I would charge, there's no world that I would charge what I actually would value my hour at. Like I literally wouldn't want people to pay that. So it creates this weird thing, because right now I have it priced at something that it's just like so grossly under what I value my time at, but I try to keep it accessible to people. That was the original idea. So, all right. Let's see. Next is an energy stock. If not, no worries. Oh no, I'm happy to look at it. I just don't know the stock. What's the ticker? That's what I'm saying. I don't know what to look up. I don't know the stock. Let me see. Tom says next is in development. The company aims to deliver reliable, cost-effective, and lower carbon LNG to support global energy sector and U.S. exports. Oh, that's good. Yeah, I like that. Dookie then says, I love how this guy is like, if you have anything while I'm away, put it down. And then when he gets back and I mention his stock, he's like, what the fuck is that? Yeah, that's facts. Well, you will hear it pretty much raw from my end. Like if I don't know something, or if I don't know what something it is, I'm gonna definitely tell you guys. Oh, I know Next. We've literally talked about Next. I actually didn't know that that was the name of the company, though. I actually just know it by the ticker, but I didn't know it's called Next Decade. I never knew the name. That's interesting. I actually think there's somebody that was just talking about this in the community that was putting on a trade. This looks good. I mean, this is like a standard breakout play. And this thing has really, really aggressive macroeconomic backdrop behind it. The downsides to this kind of thing from my lens is that it still has a lot of overhead to get through. So we can see that it's flirting with this volume node here. But as far as I'm concerned, if it breaks out on this volume node, then there's really not that much overhead resistance, like literally at all. This isn't what I would consider to be like a standard breakout play for what I would be looking for, because I don't like that on a 1-year time frame it's negative, and I don't like that on a 6-month time frame it's broadly in a downtrend. Like those kinds of things generally would be not good from a breakout lens. But this is also where it's really, really important, at least from a discretionary trader lens, to be able to selectively apply discretion. And one of those discretionary angles is, given the current conflict in Iran and the state of crude oil and the price of crude oil, LNG is in general doing quite well. So even though from a general like chart perspective for breakouts, this doesn't necessarily scratch that itch for me, the recent price performance is clearly telling us something. And then more importantly than that, it's actually in a really good macro backdrop given everything that's going on. So from just a general conversational lens so far, I like it. Now we kind of have to get a little more detailed here. So this is not good, but even though this is a great example. So this technically wouldn't even qualify for me as like a post earnings announcement drift style play because of the miss on EPS, but clearly their forward guidance was really strong. And again, this is also an instance where when I'm screening for post earnings announcement drift plays, I kind of have like a strict variant and then a loose variant. The loose variant doesn't demand that EPS actually beats. And the reason for that is sometimes, especially typically in smaller companies, you can get this exact kind of behavior where it can have not good EPS, but really good forward guidance that actually ends up dominating the investment cycle for it over the next quarter. So I don't like the EPS miss, but I do like the follow through from it. It's clearly good. And over this time frame, most of the moving averages are starting to get reorganized, which is good. On the day today, it had a big breakout, super strong volume, massively exceeding volume averages. Clearly, there's some sort of catalyst that came out today. I don't know exactly what it is, but there's no doubt in my mind that there's some sort of catalyst that hit this today. And then if we take a look at the options market really quick, go to next. That's so funny. I literally didn't know the name was Next Decade. Yeah, I mean, somebody was playing this, and this also looks like somebody at least was positioning some of this. The interesting thing is that there was a bit of an unwind here, but this is a small market, man. This is like $100,000 net premiums, which is kind of crazy. This is still really, really small. So the total premiums, for example, God damn, this is small. Like less than 500 grand. A little bit over. So really, really small options market. That can be both good and bad. But yeah, the thing with stuff like this is I find it to be way too difficult to really read into anything. And it's literally just because the total volume is so small. This can be a completely random series of small operators that build out most of this, which we can take a look at in a minute to see. And the other thing that I'm actually not a massive fan of is like most of the action is out here, right? In 2027, in January, and then in October. So slightly longer term plays, which differ from the hypothesis that I started at, which is here. Duke says April calls and market makers are buying shares to hedge. Just be careful. Like you actually can't say market makers are buying shares to hedge. It's okay to say something like, I think they're buying shares to hedge. That's completely fine. But you actually have absolutely no idea if market makers are buying shares to hedge. The point there is like nobody knows. You literally can't know. You can infer, and again, you can have a strong inclination, but you will never have certainty. Nobody will, other than the market makers themselves. So just something to keep in mind. But from a short interest angle, I do agree with you. I'm looking at the short interest right now, and the percent of float is like 15%. And the short interest ratio is like 4.6 days to cover. So I do agree with you that it seems very likely that there is some short covering going on here. I think that that's a fair assessment, because I would agree with it based on what I can see. 4.6 days to cover and 15% flow. I don't know what kicked this off. I don't know if there's a catalyst, because that would also change my perception a little bit here of if this is more just a short squeeze style play, which again, I'm not seeing that from the options market, or if this is actually from some sort of catalyst. It's an interesting name. That's for sure. So yeah, I think it's interesting. I think from the main question that would have to be solved for is trying to understand, we could do it really quick before I wrap up. Give me one sec. I need to look at something. I want to look at the general sector, so we can look at Cheniere. Yeah, okay, so it looks like it's across. Yeah, okay. So this is across this sector. Yeah, so that's good. That means it's not just a short squeeze. The short squeeze might be as a secondary function. But the good thing here is that it's very, very clearly not just that. Fuck that is. Trying to see if any of these have specific news on them. Tudor, Pickering Holt raises price target. That's it. Says. And this is just about energy in general. FLNG stock was up 1%, said that a client has exercised contract extensions for 2 ships. So it kind of looks generally across the industry, which is good. I think it bolsters the case. Interesting name. Lawrence says, can high oil and gas prices drive solar stocks up? It could. I definitely think it could if they had better institutional backing. But unfortunately, I don't think they have great institutional backing right now, because really the current regime broadly doesn't favor them. So that part aside, I think, yeah, solar is still, and again, this is one of those examples where it's kind of good to understand what's going on around the market. And it's literally because of this. If, for example, oil, LNG, let's just say general commodities were going up in price, And let's say that green power had really strong institutional backing and structural backing, then very frequently there's a much higher propensity for price follow through on those kind of names, as people will try to pivot a little bit more to that. But the reality with solar and still like more green considered energy producers is like they're just really capacity constrained. But in the current context, I actually think there could be an argument for something like nuclear, but I think nuclear power still is struggling for a series of reasons. I still really want to see SMR like begin to crush it. They're just such an interesting company, but can't really warrant any sort of idea in here yet. They kind of suck. Then there's uranium, which is not really playing. That's one of the first things I looked at, by the way. Then there's the uranium and nuclear energy ETF, also not really any play here. And then CEG Constellation, which is kind of doing its own thing, generally not well supported though. So yeah, I think not really seeing the play in energy that I expected. All right, gang, we didn't get a chance to get to the Reddit stuff, which is okay. I can just hit that maybe on Friday or something. But I think that's mostly what I had on the agenda for us. So if you guys need anything, you can hit me up in the Discord tomorrow. The skill development workshop's open to everybody, so highly recommend popping out. You literally got nothing to lose. Be an outlier. See you guys later.